What about a discounted cash flow analysis?
So this is determining valuation just based on the single company's financials. So first you want to start looking at their cash flows and projecting out their free cash flow. And to do that, you look at earnings before interest after taxes.
So
And
before you
then,
even get into that, can you tell me what is the whole point of discounted cash flow? Like, what's the theory behind it?
this isn't as market based as doing comparable companies or precedent transactions valuation method. It's looking just at the one single company, and it's using their financial, their free cash flow and projecting that out to determine a valuation. So you
But
project for,
what are you doing after you project the free cash flow? What are you doing to try and
you're
determine the
discounting
valuation?
that back to the present value.
Perfect. Okay. So yeah. So why don't you go ahead and walk me through how you get to those free cash flows?
So for free cash flow, you start with earnings before interest after taxes, and then you add back in depreciation and amortization since those are non-cash expenses. And then you subtract out capital expenditures as well as the change in net working capital to arrive at free cash flow value. And you have those, you project that out usually for a 5-year period. And then you also need a terminal value to account for the cash flows in the years beyond the projection period.
Mm-hmm.
And you can do that. There's 2 different methods for doing that. You can use the perpetuity growth method, or you can just use terminal exit multiple. And when you and then you calculate the weighted average cost of capital, which is the blended required rate of return based on the company's capital structure, accounting for both the equity and the debt portion.
So
And you,
if a company, let's say there's 2 exactly equal companies,
mhm,
would you expect a company with higher debt to have a lower or higher weighted average cost of capital?
that would have a higher weighted cost of capital usually because they're higher debt amount.
It's actually the reverse.
Okay.
Because typically equity is more expensive required.
Right.
If
Okay.
there's a higher debt,
That makes sense.
then typically, I mean, so like in terms of capital structure, if everything else is equal between 2
Hmm.
companies, the one with higher debt the blended weighted average cost of
Hmm.
capital for
That
that
makes sense.
business will be lower, assuming they're not paying a crazy high interest rate on debt because they're over levered or something.